This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujasek from Trend Spider. We have a
breaking news. What is up, everybody, and happy CPI day. I know for a lot of traders out there, maybe the market's not moving as much as a lot of people anticipated on this CPI day. Of course, the inflation number came in pretty much all in line this morning. No huge surprises to either side, so inflation didn't come in that much higher or that much lower than expected. I think actually for a lot of long-term investors, I think people liked the report, right? It showed inflation continued to kind of move in the right direction. The lowest year-over-year inflation number since October 2021. So it's about 14 months ago or so, we got the lowest inflation number. In addition to that, you had jobless claims this morning, which came in a little bit lower than expected. And now we've been talking about for the past couple months how, good news is bad news and bad news is good news with how the Fed is raising interest rates, because as long as the labor market remains strong, it gives the Fed more ability, more ammo, if you will, to keep raising rates, saying, hey, we can jack it up to 5% because unemployment hasn't even started to come up, right? The labor market's still strong. Jobless claims are coming in lower than expected. So the market actually maybe doesn't like that. I kind of have my own take on that, where I would say I disagree with the market on that. I think that's, a sign it's showing to me that the economy has been stronger than what a lot of people anticipate. A lot of people thought as soon as the Fed starts raising interest rates, boom, unemployment's going to jack up. We're going to be in this huge recession, and we haven't really seen that. Maybe it's coming. Maybe we haven't seen it yet. But for all intents and purposes, we haven't seen that effect from higher interest rates mean higher unemployment. So to me, I think that's actually a good sign. The stock market, like I said, may disagree. I have someone backstage with us, Yuri from Money and Macro. He's joining us from Europe. So he's going to be coming. We're going to be talking a lot about the European macro situation, which is, of course, going to be related and going to be influencing the macro situation here in the United States. But I'm very excited about this because we don't get to talk about Europe enough in general just on the show. So I thought Yuri Scott from Money and Macro would be the perfect person to do it. So without further ado, let's go ahead and give Yuri our very special Zinger Nation welcome and bring him on the show. Yuri, welcome to Benzinga Live. How are you doing?
Hey, Aaron. Yeah, I'm doing great. Yes, absolutely. I'm feeling hopeful here in Europe, which I'm sure we'll talk about more in a second. How are you?
I'm good. So I'm curious first off obviously here in the United States, the biggest thing people were watching this morning was the CPI report. Do people in Europe watch the US CPI report or the US inflation readings?
Yes, absolutely. Because mainly if the US central bank, which is the most important central bank in the world, is raising interest rates with the dollar strengthening, that has some pretty big implications here in Europe as well, given that, for example, oil is priced in dollars. And we have already seen that the European Central Bank has a bit of a tendency to follow the Federal Reserve. So if inflation numbers in the US are bad, interest rates are going up in the US, ECB will likely follow.
Yeah, and I think that's really interesting because when you look at around the world what central banks are doing, I feel like more times than not, they're kind of all, doing similar things at the same time, right? And a lot of times, like you said, I think it comes from the Fed down, right? If the Fed starts doing that. Although you did see some deviation from that at, a few months ago when certain things were happening in England and Europe and whatnot, that like certain banks had to take some more dovish or some quantitative easing things just to try to stabilize the economy, essentially, where we didn't necessarily have to do that in the United States.
Yeah, true. And also, I think on the other side, you've seen some central banks moving ahead of the Federal Reserve, for example, in Switzerland, where they raised interest rates a bit earlier, driving up their currency and therefore having less inflation. So I think there are some deviations, but it's really interesting to see that all central banks are essentially moving in the right direction, and at least most of them watching what you guys are doing over there.
Right. So let's start. So I know you said you're feeling slightly optimistic. So I want to start by just asking, go back say 5-6 months ago, maybe midsummer, there was a lot of talk about the energy situation in Europe, whether you were looking at England or more broadly, even in Germany and stuff. The energy prices were just skyrocketing. Issues from the Russian-Ukraine war, of course, leading to that. Is the macro situation as dire, as kind of bad as it was 6 months ago?
No, it's definitely getting better. And around the time that you were talking, I actually made a video for my channel, Money and Macro, about this Europe's upcoming recession, doing a scenario analysis. Are we going to have a bad recession, which everybody, including me, thought most probable, a mild recession, or an apocalyptic recession is what I called it then. But actually, it seems now that we're having this mild recession, even though we're not in a recession yet. So, but this is what people and me included are now expecting, a mild recession, especially because energy prices have come down quite a bit.
Yeah, and I think that's, I think people even that remain broadly bearish, that think we are still heading toward a recession. I think you've seen a lot of people shift from that, where a few months ago they were calling for an apocalyptic recession, if you will, and now it's like, yeah, we probably are still heading to recession, but it might just be a mild one. It might just be Q1, Q2, and then so going back to like when you made that video, do you think it was a lot of people just kind of doom and gloom, getting too worked up, like sky is falling, just getting all worked up over nothing? Or what were the things, besides energy prices, or maybe we can go into energy prices more, but why was that the consensus at the time that we were heading to a big recession?
Yeah, so at the time I identified basically three big macro trends that were causing people and economists in Europe to be so gloomy. And well, the first one was obviously energy. And I think Americans, or at least the ones that I talk to, don't always understand like how big this impact on us was, like how immediately we felt it, in the sense that, even my own energy bill was 5-6 times as much as it used to be. I mean, that is incredible. If you're running a small business, for example, you can just go from profitability to a huge loss in an instant, right? And then second, there was the slowdown in China, which now seems to be reversing a little bit. They're opening up, and also they've stimulated their housing market. And then the third trend was the dollar strengthening, and so interest rates need to go up in Europe to keep up with that. That could be recessionary. Dollar strength has since come down a little bit as well. China's opening up, and then energy prices were up 10 times. Now they're only like 3 times up of the average just a few years ago. So I think that pretty much sums it up why we're much more optimistic now.
Yeah, and I mean, it's interesting because at least from the trading perspective, right? For a lot of people that have been bearish the past, 6 months, year or so, to me, what I've found kind of interesting about it is the bear case has shifted a lot. And it seemed like for a while it was like month by month it was very different, right? One month it was about just broad inflation, right? Even here in the US, inflation 40-year highs, right? We're bearish because the Fed's going to have to raise to do that. Then the next month it was about European energy prices, right? Or it was about China, COVID, zero COVID lockdowns. And whether you look at any of those factors, they've started to, inflation here in the US, energy prices in Europe, COVID, zero COVID policy in China, all have started to alleviate. Not that they're not problems anymore, but maybe they just aren't quite as bad as they looked 6 months ago, which I think is now giving investors a lot more confidence to say, like, yeah, even if things aren't perfect, they're not as terrible. We're not at rock bottom like we were.
Mm-hmm.
Yeah,
Yeah, the
so
only thing I want to say, sort of bring against that, is that I wonder, and nobody actually knows, but how big the role of buffers are in this. Like, for example, some of these trends that you mentioned, uh, let's say energy prices, people, especially in somewhat wealthier parts of the world, like Europe or the United States, have these buffers. And then I wonder how close are they to the end of that? And then even though the immediate situation is better, it could still be that we get this unexpected shock downwards, I would say. Does
Yeah,
that make
no, and
sense?
I 100%. I think, and by any means, I don't want to sound like I'm some like, huge bull here. I think everything is butterflies and roses and everything's perfect. It just is interesting talking about just kind of backing up for a second, because we're doing this every day, talking about what's going on day to day, backing up and saying, remember how we felt 6 months? Like everyone felt like for sure this was going to be an '08 recession, and now it's just a little bit more uncertain. It's not that that's off the table, but it's now just a little bit uncertain.
Yeah.
So, Yuri, what in Europe right now? I'm curious, what countries, are there any countries that stand out to you that you think are in a much better economic position than their counterparts, and vice versa? Are there any that you think are in a much worse economic position than its counterparts?
Yeah, I think. Well, what we saw just a few months ago is that Southern Europe was actually doing fairly well, and that was partially because people were just so sick of COVID that they were going en masse back to Southern Europe, during the tourist season. So hopefully we'll see that return in the summer again. On the sort of weaker side, I would say two really standout sort of long-term macro cases are the United Kingdom and Italy. Both just, if you go back 10 years or something and look at how poorly they've done when it comes to real income, so corrected for inflation. Um, we tend to focus on these really spectacular events like the Liz Truss economic policy failure and then this huge crisis in the UK, and that has alleviated. But I would still say that in the long term, UK and Italy are looking still quite risky. And then notably in Sweden now, for the first time, house prices are going down, which have been going up forever, even where in many other countries, including US, including Belgium, Netherlands, where I'm based, had been going down. So that's a first, and could be quite a big impact given that they have so much debt. And then Eastern Europe, where they rely much more on Russian energy, and so they had much higher inflation than elsewhere, is also still a bit risky because of the energy situation, I would say.
Yeah, and I think too, like you have the different countries in Europe right now, like you said, have different kind of exposures to the problems from Russia and Ukraine. Um, how long do you think? I mean, I assume that the housing prices in Sweden coming down, at least partly due to that, is because of central banks that have raised rates, right?
Yeah.
How long do you think that in some of these countries or in Europe more broadly, that the central banks can keep raising interest rates or keep them high at their levels right now, before you do start seeing some economic like turmoil from that?
Yeah, that is $1 million question, isn't it? Yeah, I think it's just so unprecedented in the sense that we do still have fairly high levels of debt, especially in a country like Sweden. Yeah, it's so difficult to say, and also, housing had this big impact on the economy for a long time now. Having become so important that house prices keep going up, people can then spend more. It's only slowly reversing now. There's probably a big lag between housing markets and interest rates. So, yeah, no, it could even be that interest rates are declining a little bit, but because there's such a big lag, housing prices will still come down. And because people also sort of hope for rising prices, this could go on longer than when interest rates are coming back down.
Yeah, and I mean here in the U.S. we've seen the way inflation has worked throughout the last like year. We've seen different items, different things kind of be drivers of inflation at different times, right? Like 6 months ago, gas prices here in the U.S. were the highest they've ever been, and really like the main driver of inflation on the CPI report. And now gas prices or petrol prices have
Mhm.
since normalized, but rent was a huge driver of inflation the past few months. That rent was like 20% higher than it had been in the previous years. And like you said, that takes a while, even as rates go up and housing prices come down. Okay, so first now the apartment building price comes down, and then it probably takes a few more rents or months before that becomes passed down into rent. And then it takes a few more months for that reporting to come into the CPI report. So even if those rent prices have come down since the Fed has raised interest rates, we might not know that full impact for another 6 months or so, which is, I think, why you have a lot of people who criticize, say, why are we looking at all these lagging indicators? Why are we looking at, instead of a sort of like a real-time inflation gauge?
Yeah, because that's the best we have, I would say, right?
Okay, yeah.
Yeah, I wish there was, but these things are important components of inflation, right? Rent is a really important component of inflation. Yeah, it is lagging. If these people could come up with a better measure, I'd be happy to hear about it.
I didn't know. I was hoping. I didn't know if you were going to be like, oh my God, that's how you guys are still doing it in the United States. Here in Belgium, we have this, inflation index that is way better.
Yeah, I wish. No. We don't have better economists here.
All right. Well,
yeah, we're on the same
I
level.
know it's
Let's put it like that.
okay. So I guess maybe the best economists in Belgium come here to the United States.
They do. Yeah, they do often. You pay better.
Yeah, there you go. So Yuri, I know we're it's later where you're at. It's about your dinner time, so I'll go ahead and let you go. But before I let you go, I want to ask you one final question. This may be the toughest one. I want to hear a bold prediction for 2023. Could be, macro related, could be Europe, could be US, or it could be a sports prediction if you want. I just want it to be a bold prediction, a hot take. Not something you think is necessarily going to happen, but something you think is maybe on the table.
All right. So what I think might be on the table and that is that we might finally see the dollar losing power as an international currency. I've been following a little bit some moves by, for example, the Central Bank of China, where they're building these connections with other central banks, like, for example, the Central Bank of the United Arab Emirates, trying to replace the dollar, which is extremely difficult because the dollar, has this huge network effect. But that could also mean that if something happens, it happens rather quickly. Or slowly, but I think we might see there is now a chance, given that there are so many plans going on there, that we could start seeing the dollar waning a little bit as the primary international currency. But I'm not sure about this.
So not necessarily losing its status as like the global reserve currency or the go-to, but just losing some power as like the main currency.
Yeah, that we see a phase transition. So a transition from, this upward or relatively stable trend to a downward trend when it comes to adoption of the dollar, reflecting that we're moving towards a more multipolar world politically than also monetarily.
Got it. Well, if it doesn't happen this year, then it does seem like we are on that trajectory in general. So I like that prediction, Yuri. We'll be watching the dollar, seeing how that unfolds. And I honestly didn't even know that the Central Bank of China is building some of those relationships. So that's interesting. That is something we'll have to keep our eye on.
Yes, I'll be making some videos about it on my channel fairly soon.
All right, beautiful. I'll tune into those. All right, well, Yuri, thank you for joining the show today. Hold on, I'm gonna try to say your last name again. I know I butchered it though. I said it right when I had you backstage, and then I couldn't say it when I was saying it on the show. So, Yuri Skasfort.
Yeah, exactly.
Yuri Skasfort.
Well done.
All right, got it.
Perfect.
Go ahead. You were gonna say and something.
Oh yeah, I mean, in Dutch we would say Skasfort, but I'm never asking any English-speaking guests that I talk to try that. So Skasfort is perfectly fine. Yeah.
All right. Next, I'll practice my Dutch pronunciation. Next time we have you on the show, I'll go with that one. But Yuri, thanks again for hopping on Benzinga Live today. I'm going to drop the link to the channel, Money and Macro, in the chat. Everyone go give the channel, go subscribe to the channel. If you would like to see some more great content from Yuri, enjoy the rest of your Thursday evening.
Thank you so much. Thank you for having me on. Cheers.
Of course. Cheers. All right, guys, that was Yuri Skasfort from Money and Macro, dropping that YouTube link in the chat if you're interested in what's going on in Europe, if you're interested in macro more generally or Forex. You heard Yuri talking about the dollar and some different currencies. Go give them a follow. It's a great YouTube channel. That's how I came across Yuri's content. I do see our next guest hanging out backstage as well, Mr. Steve Kalyjian, joining us from here in the U.S. now. We're going global today. I'm going to give Steve our very special intro, and when we come back, we'll bring on the man with the most monitors in the world. Mr. Steve, how you doing today?
Hey, Aaron. Good morning. Good morning, everybody.
Good morning. Did you get not screwed around in the CPI report this morning?
Now you wait for the dust to settle. They pushed right down early, and then they tried to buy them. It was too fast, and then it just ricocheted right back up, pulled in a little bit, got above, got above the 40-20 right after the opening on the S&Ps. Caught some big sell divergences on a lot of cap stocks, a lot of big on the ETFs. And within 15 minutes, things were down 1 to 4%. I mean, it was just pretty crazy. NVIDIA, Netflix, Microsoft, Apple, Amazon dropped $3.50. All 4 ETFs. I mean, the S&Ps dropped down to the down to new lows on the day. So it was pretty intense, 70 handle drop from high to low. Then we bounced off that about 40 points. So the model for 2023 is going to be volatility, and it's here to stay.
I like the volatility. I have by the way, Elon in the chat says he's got a couple more monitors if you need some more. Also, someone in the chat calling you.
I need more Eli. Tell him to bring them.
All right, I see someone in the chat called you a super bear. Would you say that's an accurate description of your, sentiment right now?
I mean, I think this year of 2023, I don't know about super bear. I was very bearish last year. I mean, like jumping up and down bearish. This year, what do we have? Maybe 800-900 points worth of risk on the downside on the S&Ps, and 2,500 points to the upside when this is all over. So when I see that they get to my levels, and then when they get to that first rate cut sometime in 2024, I think you're going to see a year and a half, 2 years of a monster bull market. I'm not a super bear. I think there's opportunities every single day in the market. You trade what you see. I think we're going lower before higher. I think there's a lot of things broken here in the system. I still think 6.5% CPI is staggering. I mean, you had 40-year highs, so they had to come down. But again, like we talked about, still eggs are $5. People tell me that eggs are $5 a carton. I mean, I saw a report, I think a week ago or 2 weeks ago. The average income is spending $10,000 more per family per year. That means you got to make $20,000 just to break even. I don't know anybody getting a $20,000 raise. So I'm not a super bear. I mean, I'm bearish, but I think that, we're going to trade down, make lower highs, trade down, make lower highs. Bear market rallies are more vicious than bull market rallies. And I think ultimately when we get to that level, if I'm correct, about 1,100 points lower from here, they're going to base for some time, trade up and down. And then once they make that first rate cut, you're off to the races. Monster bull market.
Yeah, I'm just curious, Steve. I know toward the end of last year, I forget exactly, or I guess we've got the SPY chart up right here. I can see whenever I want to say it was like October or so, whenever we, came down here. Let's see. Yeah, October 15th. At this point, you said we've seen the lows for the year for 2022.
Yeah.
So at that point,
mid-October.
What factors, and I know you have your own like proprietary indicators and all this, but I'm saying what factors made you maybe not even bullish there, but not bearish, made you bullish enough to the point where you knew the lows were in for the year? Mm-hmm. And what's changed since then that would make you bearish now?
Well, first of all, you have a ton of overhead resistance here. You have significant supply above the market. When I called that low, I had probably one of the best buy divergences I've seen in quite some time on the bigger time frames per se. Here now, I just think that the market is in a wait and see attitude, and so basically what we're looking to do now is every single day there's opportunities in the market. For me to take on any long-term positions, I need to see a capitulation to the downside. And I don't think we're nowhere near that. Do I think these lows will be broken this year? Absolutely. The 3502 on the S&P from December, from October of last year, I think that they will get broken this year. When?
I mean, okay, and I understand all that, Steve, but I guess just play devil's advocate.
Sure.
What if for the next few months we see what we've been seeing, and we continue to see what we're seeing, and that's inflation coming down, maybe not quick enough that some people would want to see, but we got the lowest year-over-year inflation number today that we got since October 2021, so the lowest year-over-year inflation the past 14 months. And a lot of people thought, 6 months ago or whatever, that as soon as the Fed started raising interest rates, we were going to see a huge uptick in unemployment. The recession was basically going to start like that. And we haven't really seen that. So if the labor market remains strong, unemployment remains steady, inflation keeps coming down, would you get a little bit more bullish, or would you still think we're going to see new lows at some point?
I'm not going to be bullish until they start cutting interest rates. Absolutely not. I mean, the thing that the bond, again, you have to look at the 30-year bond market. The 30-year bond market low is around the 117 and change, 117 and a half. We ticked almost we were above 130 today at one point. So the bond market's telling you, okay, that things are going to be worse than expected. The 30-year bonds are telling you that, because so as they're raising rates, bond prices should be going down. Bond prices have rallied almost 10 points off the low, more than 10, 12, 13 points off the low. So basically, if that happens, the bond market is telling you that we're going to go into a recession and things are going to get worse than expected, and then they're going to have to cut. And then if they cut, the bonds are going to go into a monster bull market.
Yeah, and I think, that hypothetical, obviously, it's like the Goldilocks scenario that I laid out, but it's basically been, like I said, what we've been seeing the past few months, and that inflation is coming down somewhat. Like I said, not as much as we'd like to see, not as much as we need to see, but unemployment hasn't come up so much. So if that continues...
Well, I mean, you're looking at Goldman Sachs cutting jobs. You're looking at a lot of these firms cutting jobs here. I think it's going to start cycling in the next couple of reports that you're going to start seeing unemployment rise here. And I think, Powell actually said that he expects people to lose their jobs. All right. In one of the minutes he was speaking, or the press conferences he spoke about. But here's the thing, though, 6.5% down from 9% is in 3 months, 4 months, is, you might think that's a great thing, but 6.5% unemployment, 6.5% inflation is still staggeringly high for most people. I mean, I know people who are struggling beyond words here, and yet they say that the labor market's strong. Well, I know people who can't even find a job right now. I mean, I'm not talking $250,000 jobs. I'm talking $75,000, $85,000 a year jobs in their fields. So, and I don't think that this picture really portrays what the American people really. I mean, rents were up 1.8%. I saw the report, and so the average person is still struggling. I mean, gas prices have come down, okay, a little bit, not to the levels that we've seen prior to this, in the low 220 range, 240 range. But food's still staggering. I saw lettuce. People came and buy lettuce. They're so expensive. So I think that, and then the offset this, our deficit is near $32 trillion. I mean, this is unsustainable. Our money's going to be worthless, which is another topic for another night. But I just think that if you look at this chart here on the SPY, this is what's it, a 1 day? Is it 1 year that you have up here?
This is daily, going back to, about a little bit more than a year.
I mean, look at all those lower highs. all those lower
Right.
highs.
Here,
I think
here.
we're just gonna keep doing that until we. Remember, I told you I have a piece of I have an indicator that I think we're gonna be very close to matching, not as low, but matching the pattern of 2008. Now, I'm not saying we're going to go to 6,000 on the Dow. We're not making new low. We're not going to make the COVID lows of 18,000 and change. I'm not saying that, but we'll make a higher low, somewhere between the 23 and 25,000, probably the 24, 25,000 range, 26,000 range. Then I think we base, and then we go up from there. Then you'll see Dow 40,000 in 2 years.
Yeah, I mean, I like, obviously having people, I like getting people on with different opinions. I guess I'm surprised, I think, or I'm not, I guess I shouldn't say surprised. I think it's interesting, I guess I wouldn't be trying to go that far out because I don't know in a month from now what the inflation number is going to look like, what the Fed's going to have to be doing, what the bond markets are doing. But everything to me, Steve, for the past couple months has seemed pretty good, right? That we're in a better position than we were 6 months ago. When we were making new lows, whether it was here in October or September, I think we're in a better economic position than we were at that time.
I don't know if we're in a better economic condition. We just raised the deficit by almost $2 trillion, right? You got a lot of people still out of work. Again, all those job layoffs have not been calculated, and they'll start being calculated into the next report and the report after that. Amazon, Goldman, all the big firms. So I don't know about a better economic condition. However, my point here is that 6.5 on the CPI, they were looking for 5.7, right? I think Morgan Stanley was looking for 5.7 and a 2% rise in the market. Well, okay, we came in at 6.5. I mean, so at 9%, they dropped 2.5%, right? That's not that great. It's good. It's a great start, better than 9%, but nobody's really seeing it in the food prices. Food prices still relatively strong, right? I don't think things are coming down to where they once were. I paid $4 for a quart of milk. I remember buying that same quart of milk for $2.65 or $2.45 well over a year ago. So I don't see prices coming down on food, and that's what people obviously need to live on, right? So I think these numbers are good. They're better than 9%. They're better than 8%. They're better than 7%. But there's still a long way to go.
Yeah, I mean,
Jari's saying 5.5% potentially on the Fed, which is another full point.
Yeah, I know there are certain areas. I think we've talked about the egg prices and food prices and whatnot, but yeah, I mean, I guess that will be. But I guess my point was just a few months ago, it looked like the Fed was not going to have any choice, any ability whatsoever. They were going to be forced to keep raising rates because inflation was just so out of control. And now that it's, at least in some areas, whether you're talking about gas prices, rent, housing prices coming down, looking somewhat better, inflation. Steve, I'm not saying that, okay, we're all 6.5 is something to jump and scream about. I'm not saying that, but just that it's better than 8.5 or better than 9.5%. That maybe now some investors, maybe even some big banks are starting to think about, okay, how can we position ourselves to when the Fed is able to start cutting? And if it's not, in this quarter or the next quarter, then maybe it'll be the quarter after that. And I don't know when those banks are when big players, when investors start looking far enough out for that, but it might look sooner now on the horizon than it did a few months ago.
I think there's a 95% chance they do no rate cuts in 2023, and maybe a 5% chance they drop it by a quarter at the end of in the fourth quarter of 2023. I don't see any rate cuts this year at all. I think there's also, nobody's even talking about that inflation can get another bip up here. You pulled in 2.5%. Doesn't mean you can't go right back up here again.
Yeah. All right. Well, Steve, what about any individual names you like setting up either for longs or shorts here?
I mean, stocks are getting decimated. I mean, a lot of Google, Tesla, Amazon, they're down 20, 25, 30%. I wouldn't, the only name I think there's a lot lower prices coming. So I'm really, unless there's a big aberration to the upside, like a big, let's say if the S&Ps get up to, I'm just saying 4,100, 4,150, 4,200, I'll be then looking to short everything. If they drop them down and you got these big divergences, and let's say they drop 200-300 handles from here, 350, then you look for buy divergences. So right now we're in no man's land. There's nothing to buy. There's things to intraday trade, but I don't see anything to do here position wise for the future, long and or short, not at these levels.
Got it. Well, I think, you saw me I'm going through some different indices right here. XLE looks like energy is having a good day today, up more than 2%, which to me, like, I like seeing that. To me, that tells me, and seeing XLE and XLF, the financials and energy trading up today, is saying that maybe people think the underlying economy isn't gonna, come to a grinding halt, that energy and financials are still trading well. But then you have some tech names like the Qs. Actually, the Qs are positive, but I'm looking at Apple still down on the day, Tesla still down on the day. So it is interesting to see the strength in names like Chevron, ExxonMobil. I think Natty's having a good day. Let's see, LNG, liquefied natural gas, is having up almost 3%. Cheniere is here. So any names in the energy space you've been watching?
I look at Exxon a lot. There's a lot of overhead resistance here around the above the 12 level. On the 112 level. So, and I'm not really a bull on it. I'm think there's better shorting opportunities in Exxon. I think Boeing has gotten way ahead of itself here. We had some good shorts this morning in Boeing. I think if Boeing is up to the 216, 218 level, it's a screaming short. Again, I look for names here that are you get these gigantic moves of euphoricness or capitulation, and I think that's how you have to play the market going forward. If you want to swing trade names that have these gigantic moves and predicated from short covering rallies or whatever, these are names I'd be scaling into any long and or establishing short positions for moves down. That's how I look at it going forward. There is a ton of overhead resistance in this market. And until we base out and bottom at much lower levels sometime this year, I don't see right now, currently at this particular moment, there is nothing that would make me want to buy and hold something long end or short right now. Right now, you're seeing the markets in a range. We've been in that 38. Well, we pushed down to 37.80 about 3 weeks ago, 2 weeks. And then we were hovering in the 38.80, 3900 range. We broke out of that, got up to that 3930, pushed up to 3980, pulled in. Now we're in this 3800 to 4000 range for like the last couple weeks now. So there's nothing that would tell me to jump in to position something of any quality. I think, again, if that happens, we get a sharp rise of 200 points, 250 points on the S&P, I'll be looking to short them. If there's a drop significantly of 150, 250 points, I'll be looking to buy them for trades only.
Got it. Well, Steve, it's always good to get your thoughts on what's going on with the market. Good job on that short on Boeing earlier today. It is coming back up. I just had Boeing's chart up on what was it? Let's go to a 5-minute chart here. You can see we got right up to where we topped out at this morning, right at 10:10 a.m. So
we had to buy below the 212 level to cover the shorts and to go long. Got down to like 211.45, I think. We had a beautiful pattern on that, and then we called longs there. Now they're pushing up here again as we speak. So, and Bullard was speaking. S&P's just traded down to 84, just traded now up 04. So they're moving 20 handles at a clip here, 10 to 20 handles on a clip. So but we're going to be getting some sell divergences real soon here. again, any push up to new highs on the day here, or any push up in the next day or two, is going to be met with significant sell divergences. So this is going to be short lived in my book.
Yeah. We'll see. I mean, we're seeing. Let's see how we're looking right now. Looks like the SPY kind of ripping up toward its high of days. Let me switch over to SPY from Boeing. Looks like we're trying to take out
S&P's at 421.5. So we're about 15, 16 handles from that. So right now, so about $1.
Yeah,
right.
I was talking about the high of the session, but pre-market looks like we did get up to about 398. So we've
got a ways to go there. And again, any push up to those levels is going to be met with staggering selling, if you ask me.
All right. Well, Steve, as always, it's a pleasure to get you on the show. I'm going to go ahead and drop that link in the chat, tradeeasy.com. If you want some more info and content from Steve, make sure you go check out tradeeasy.com. Steve, enjoy the rest of your Thursday. Enjoy your weekend.
Take care. You too, Aaron. Have a great weekend. Bye, everybody. Take care.
Bye-bye. All right, guys, that was Mr. Steve Kalyjian, tradeeasy.com. Come on, SPY. Look at this. Come on, SPY. We're at we're up 0.4%. Come on now. No. What are you doing? Why are you going down? Why are you red? I don't want to see any more red candles. Let's just see if SPY can keep going again. Like, the big question will be if we do keep coming up to this pre-market high, which again was at about 398.5. I want to say it's showing me right here. 398.75. We'll call it 399. If we get to 399 on SPY, we take out that pre-market. Woo! Then we could see a rally this afternoon. But just be cautious out there, because we've gotten a big move to the upside now in just the past like 10, 15 minutes or so. So could potentially see a pullback here at some point. All righty, y'all. Quick rundown for the rest of the Jay, right? Yeah, I mean, Jay, I will say I also was surprised by that. You know, like, it seems like yeah, we won't get too much into that. We trapped the bears. Now let's go up. Nice to hear the different opinions, always buyers and sellers. Yeah, and that's why, you know, like, I think right now, and if you guys have been watching this show for a while, my position hasn't really changed the past like 6 months or so, is that I've been like I've been bullish to like I'd say if 10 is Super Bowl and 1 is super bear, 5 is completely neutral, I've been at about like a 7 or 6.5 the past, like, 6 months, basically being like, I don't know if things are really as bad as people are making them out to be. Doesn't mean I'm, buying SPY on leverage right now, or buying SPY on margin and going as long as I can. No, just that I don't think, when we were talking about like the Europe energy situation, and I was seeing headlines that said businesses may have to shut down this winter so that people have enough power to heat their homes, I was like, I don't think that's really going to happen. I don't think England's really going to be in, a 1980s type thing where we saw in the US, where we had to try to conserve energy and lines at the gas station, like all these kind of doom and gloom things that we were talking about and seeing. Even the China situation, like, things have gotten slightly better. So it is good to hear an opinion from someone who's more relatively bearish, since I'm more relatively bullish, and I'm open about that. So I may have my biases because I am more bullish right now than I think the consensus is. Again, does not mean I'm the biggest Super Bowl. That's pretty good. I wonder if anyone's ever figured that out before. Anyway, he's the all-seeing bear. Yeah, and I'm the all-seeing bull. No, and that's the problem, is like, someone like Steve who's more bearish, and someone like me who's more bullish might see the same data and interpret it very differently. Like, I saw the inflation data this morning. You heard Steve saying like, oh, it's still 6.5%. That's crazy. That's way too high. We got to keep raising rates. I saw it, and I saw it as that's the lowest inflation number we've seen in the past 14 months. We're on the right track. We're doing all right. So it all depends on what you want to see. EKS talking about SECCO. This is one we talked about. I don't even want to talk about it, man. I screwed myself up on this here. I'll share my Robinhood screen. I had no conviction on this trade. Absolutely no conviction. Look, let's go to this. Southern Copper. Go to my history. Show more. Bought in size, by the way. This was like my biggest position in my portfolio. Bought 60 shares at $63 and sold like literally 4 days later. Look, June 6th to June 8th, sold June 9th and June 13th at $57. What's it at now? What's that CCO now? Oh, $75. Jeez. Would I sell it at 57? Now it's at 75. And I love this name. I talked about it on the show, why I liked copper. We might have even had someone on from Bloomberg that talked. No, you know what it was? Is I listened to Odd Lots podcast from Bloomberg with Joe Weisenthal and Tracy Alloway. They had a copper expert on. I want to say this was it's when I bought the stock, so whenever that was, in June over the summer, so about 6 months ago. They had someone on the podcast that basically talked about like why copper was going to be the biggest thing ever, like the best investment ever. And so, okay, say he was on in June, SCCCO was at 60. I bought the stock. It starts dipping. I was like, all right, this guy doesn't know what he's talking about. And then it got down to $43, and that's when you really wanted to start buying, it looks like. All right, but anyway, guys, I see our next guest hanging out backstage. My man, Rob Roy, joining us from the Northeast region of the United States of America. Let's go ahead and give Mr. Roy our very special Zinger Nation welcome. And when we come back, we'll be talking to Rob about what types of options trades, what type of spreads he's been making, and what he's seeing with the market, what he thinks about the inflation report this morning. So without further ado, let's go ahead and give Rob our Zinger Nation welcome. Mr. Rob Roy, how you doing today?
I'm great, Aaron, and yourself?
Good. Good. Could not be better. I saw you. Looks like you were, hands back, chillaxing backstage. You must not have any stressful trades going on right now, huh?
No stressful trades going on right now. I did not anticipate today to be the day. Threw some trades out there this morning in our pre-market notes of what we were looking at for the day for some spreads. We got some really nice moves on them, but I think everything was so overvalued anticipating what was going on today. You see a huge move in the price of the stock, a couple of points on a $20, $30 stock. And then the option price opens up at a set rate, and then it just stayed there, even though the stock has moved in the right direction. So I was anticipating some of that. I didn't take any of the spread trades today. We only got one trade off today, which was MasterCard. It was like 70, 80 cents, a dollar, somewhere around there we picked up on it. Wasn't anything crazy for the day, but it's just with where we're at in the market and in the chart. And I listened to some of what your last guest was talking about, and I agree with a lot of what he's saying there as far as I don't see us in this bull market yet. Yes, we've bounced, but that bounce came off of, in reality, that bounce came off of this sideways move that happened in the S&P 500 for about 3 weeks. And we got that quick bounce off there. But if you look on my chart, you'll see this overall. I think I'm sharing, right? I am.
Yeah, I just got to pop it up on my end. You are sharing.
That's fine. So making sure it wasn't on my end that I didn't get it out there yet. We're sitting right up at this downtrend line. I'm going to back it up. It's going to be a little. There's a lot of stuff on this chart happening there, but just to see the overall downtrend lines on the S&P, and we were sitting right there yesterday on the close. And today, if you watched before the CPI came out, we were 2 or 3 minutes before, we were up over 100 points. And then we were down 200 points right before the announcement, and then all over the place from there. I think there are a lot of individuals out there that want the market to go up, whether it's ready to or not. I'd love the market to go up, but I'm not the person that says, I need the market to go up. I want it to go up. I'm ready to buy now. I'm waiting for Aaron, I'm waiting for the right opportunity and the right setup in there. And with us pressing up against a major, major resistance level, not only on the daily chart, but also on a weekly chart, pushing right into that major resistance, and a monthly chart back to the same major resistance. I have a problem going long on positions right now and thinking I'm going to hold on to those things because we've reached the bottom and we're ready to go. So for me, I'm still very much a believer that we are headed further down at this point. Prove me wrong. I'd be very happy to be wrong with it. But I don't think we're ready to make a steady move to the upside. I think there's too much external forces that are still bad. The CPI coming out what it was supposed to today, okay. Don't know.
Yeah, and I mean, I think, it's important, I think, to kind of where we're making the distinction between like looking at the market and how we expect the market to respond, and then when we're talking about kind of the overall economy and stuff. And my point, and I guess being, like more bullish than the consensus, is just when we were at the low point in the S&P 500, right? We were really pricing in like a mid to severe recession, like all these things. And I just think that the overall outlook isn't as bad. Like I just don't, for people that, and I understand what you're saying, Rob, is that you're not saying that, you're super bearish maybe, but just that you think we're having trouble maybe once we hit this resistance level, or we're not going to see maybe a sustained bull market. But for people out there, not you, Rob, like I'm saying, but there are other people out there that think we're heading straight back down to those bottoms. I mean, to me, it's like something bad would have to happen to get us back down there. If you think about where we were in terms of inflation, zero COVID policy in China, the Russia-Ukraine war, all these things, like something macro, something big would have to happen, in my opinion, to get back down there. I don't think where we're at right now puts us back down there.
And I agree with we're not going straight back down. I just don't see us going straight anywhere, up or down. I think you're going to get periods of up. You're going to get periods of down. You're going to have this slop to contend with. For myself, Aaron, I'm a technician. I'm a chartist. This is what I do. I just geek out over looking at a chart and finding something on it, or finding a new pattern that just presented itself today on one of the stocks that we're looking at. I love it, right? So when I look at this, what do I see? I mean, we had this double top-ish pattern in here that failed. It put in a lower low off of this low down here. And now, yes, we're pushing up into a resistance level. If we do roll from here, it gives us another lower high. We're not there yet. We're not rolled over. We're not ready to come down this second, like today we're going to crash. I just don't personally feel the belief, or see the belief, that we're going to go straight back up again, and this is the time to load up. Unless you are in a position, Warren Buffett, right? If you're going to buy a stock for a day, be willing to hold it for 10 years. If you're in the position that you're willing to hold that stock long-term, then that's awesome. Even though it pulls back, then that's great. You've got to have a very defined plan for how you're planning on buying long positions at this point. For me, it's all intraday trades. I'm in, I'm out. We don't do the day trading where I'm trying to do 50 and 100 trades a day to pick up a nickel or a dime. That's not me. My goal is, to trade a Tesla or a Netflix or even a Roku, which has a phenomenal move. I think Roku gave us, we just did some measurements last night on last year's numbers. I think Roku was number 10 in profitability for us last year. Let me see what that was. Let me just open this other sheet up. So we look at, all right, so let's look at Roku. So Roku was 3.72% of our P&L last year, which was $53,430 on Roku. 25 trades, 20 winners, 80% winners on our trades. We had 2 break evens on the position. 3 went against us and 2 that broke even. So you got a $50 stock. Yes, it was as high as 100 in the last year. But in the last 5 or 6 trades we've taken, they were at that $50 to $59 range, 52 to 59. So I would rather find a company like that and go identify a trade that we can take that gives us a decent return without me having to hold on to something overnight and wishing that I could sleep tonight because of how bad my concern is with the overall market.
Well, yeah, if it makes you feel any better about being, I don't know how I'm going to be able to sleep tonight, Rob. I've got some options that expire tomorrow that I can't sell today because of my PDT rules, and now I'm just going to be forced to hold them, I guess, overnight. So we'll see how that goes.
Wait a second. You have an option that you've already entered, correct?
Today, yeah.
They should allow you to sell that position. Was that your third?
Well, I can sell it, but the problem is if I do sell it, I will. Okay, so if the option price gets out of hand and it goes up more than it has already, I might sell it. But if I sell it, I have 90. I'm basically in the doghouse for 90 days on my broker, which is fine because I have other brokerage accounts, so I'm not really too worried about it.
Right. Yeah, and there's not even really a lot of choice in there. They really can't even fudge with that. Brokers are self-regulating. They all get audited by the SEC or FINRA, whoever their regulating firm is, and they look for stuff like that. They've got to make sure that they took regulatory action, or else they get fined for it. So, but I understand. You know, it's a tough place to be. There is a way around it, Aaron. Not today. There's not. But if you get rid of your margin agreement, that gets
right. Just make it a cash account.
Then you no longer have a pattern day trader rule. But what you have there is, I'm going to make a number up. You got $5,000 in your account. If you bought an option for $5,000 today and you sold it, you're done for today. You can't do it. I know.
So that's what I ran into. I had that happen. So Robinhood recently gave you the ability to switch it to a cash account. Started trading. I was like, oh, this is great. I just made 10% on this trade. Now I'm going to do another trade. Did another trade. Made 10% on that one. Next thing you know, my buying power was gone for the day. And I was like, what the hell? I just made, where's all my buying power? And then the next day it was there. So I liked the freedom that came with the cash account. I didn't plan for that aspect of it, but now I know. So next time I switch it to a cash account, I'll know to just keep some dry powder in the bank at all times.
Right. Or look at it as you could still do 5 trades a week with a cash account versus a margin account.
Yep. All right, Rob. So you mentioned Roku. I can't see. Let's see what we got pulled up on the screen. You've just got SPX up right now.
It's SPX,
I want to go through some more individual names that you might have some setups on and why you like them.
Sure. So I'm gonna bring it in a little bit for us, make it a little bit bigger on the screen.
All right, I'm gonna make it full screen on our end too, just to make it easier on our audience.
Yep. All right. So that's as tall as I can get it. So I love Amazon, the way that it's set up. It had a nice close up yesterday, and I would be looking, if it was not a CPI day, Aaron, I would have been looking at this today for the bounce off of this fib line, which we got. We gapped up, we came back and retested it, and we bounced. I didn't take it. Wasn't sure if we were going to hold, we're going to fail. Just very uncertain on the S&P right now. So this was very much I call this position 1 in the chair. You can't reach the keyboard, and you're just waiting for the setup to present itself properly, right? So I like this. If we close where we are, give me a retest of the 94.24 and a bounce tomorrow, and I'm looking at 99.5 as resistance. So 99, 98 3/4, somewhere about there is where I'm going to be out. And my stop is going to be down here somewhere about 93 on this position. So and I've got to bring my symbol grid back in here. So we move about $3.35 a day, let's call it, 3.25 a day. So 94.99. So we've got plenty of room in there. It's not like we're going to run our head into a ceiling. We've got plenty of room in there today. For tomorrow, if that does take a bounce, we've got the ability to make a move. So there's plenty of upside potential. So I like Amazon a lot for their setup.
Yeah, and so if you like Amazon a lot, I mean, wouldn't oftentimes Amazon trade with the other, big tech names? Like if we look at QQQ's chart, for example, like would that be setting up similarly, do you think, or does Amazon have a much better setup right now than its peers?
Nope. So Q's has a similar setup, except the Q's has actually had a bullish move on that candle. They've risen higher, where Amazon has not participated in that. But the Q's where they sit right now, we are more than halfway through our fib lines here, the center of these fib lines, more than halfway up. If you look at my horizontal line, you can see we're just slightly above that 50%. That's about 50% there, the horizontal. So we've got a good distance already. That's a far distance for a pullback and a bounce for me to go, yes, it bounced. Well, wait a second. Why do we have that much pullback? We have a small, when we close closer to a support level, get in that 276, 277 level, get a pullback tomorrow to 276.5, 3/4, and a bounce, then I'm all about it. But if we close where we are here, it's a little bit further up. Could you have taken that trade today? It had the exact same pattern, Aaron, you're right, as what Amazon did today. So the same setup as Amazon was there for today.
Got it. Anything in the energy space? I noticed today the XLE, you had a bunch of, energy names, Chevron, Exxon, especially some natty gas names, LNG, all performing well today. Have you been watching any energy names?
I have not traded any energy positions, primarily because we've been in this slop, right? When you look back in here, this was just this pure sideways move. This one, if we put a rectangle around that, which we do all the time, I call it a dreaded box of neutrality, right? We're going to put that rectangle right about there. Right? I'm not trying to get the lowest low and the highest high. We're trying to get the most hits we can off of support and resistance, top and bottom. So we had that. We broke out of there a little bit, and then we set it up all over again right in here. And we put another rectangle in. We finally got the breakout, but that breakout very quickly gave it back. And so I haven't focused on them. And a big part of it is, I love an ExxonMobil. I think they're a nice mover. They're great for diagonal spreads. I'm a big fan of them. But until we break that 114.66 level, I'm not interested in really doing anything with it, just because it had been in such a sideways move from end of October.
Yeah, I mean, I haven't really been in any of these energy names. I've been watching how energy's been trading, because I think the way I've been watching it has been, I've been looking at it through a lens of if we are heading toward this recession, that I do expect to see a lot of these energy names roll over. And kind of the other side of that, the flip side of that coin, is that the stronger energy names continue to trade, the less likely I'm viewing. And I know it's not that binary or not that simple. But, that's kind of why I've been watching XLE and energy names in general throughout the past few months. I've been kind of watching it through that lens. What about financials? Any banks or anything like that you've seen set up for anything interesting?
So Goldman Sachs on the side of the brokerage / bank, right? I mean, we had a great breakout from yesterday. Yesterday's move up. So we had the close here on the 10th, okay? So we get the close up. Yesterday, we gapped up just above that 358.44 level, right? So let me write it down so I don't forget it. 358.44. Let's go look at Goldman Sachs intraday on a 5-minute chart. And we're looking at 358.44. And this was from yesterday. So I've got a 62 in here. So let me we're close enough there. So, Aaron, we got the gap up. We moved up higher. We came back and we closed right back down at our support, and we bounced. That was the entry into the trade right there. That's exactly what we were looking for Goldman Sachs. Take that entry. And yes, we had to pull back. We took a little bit of heat in there, but you're looking at about 360. And we were out towards the end of the day. We got out right below this, about 364, I think it was. So about a $4 move yesterday on a bank. Goldman Sachs is one that we look to trade every day. I like them a lot. I like their move. I like their pattern. I think they I think they set themselves up well for traders. A little more expensive on their options than some of the others, than maybe the Bank of America's might be, or the Citigroups. But I do like them a lot.
Got it. So why don't we, I want to discuss kind of like how we would lay out maybe a spread, a type of option trade on a name that maybe, let's say a name that you like to the bullish. That could be Amazon or Goldman or one of these names we already looked at, but maybe a name you like to the bullish side, but really you're just essentially betting it's not going to go down a certain amount, or how you would set up a spread.
Okay, so if I'm looking at Goldman Sachs, the first thing I'd want to see happen tomorrow, let's say, to set that spread up, is I'd want that break above that 370.34. So I'd like to see it get to at least 371 or so, and maybe just pull back a little bit. Doesn't have to come all the way down, but what I'm looking for is this. The stock closed here last evening, or tonight, let's say. Tomorrow, it moves higher. It gaps up, runs up, whatever it is. It moves higher, so the bulls are still in control. I want the bears to try. And I want to see that pullback take place. And then as it pulls back and gets to support, the bulls jump in and say, yeah, we're not ready for you to go down. We're going to go and attack. And we see that bounce. There's strength in that bounce versus a breakout. Go ahead and check any support or resistance line you have and look at how many times it's hit that line, pierced it, and pulled right back in, trying to take that breakout, Whereas if you let the breakout happen, retest and bounce or fail, whichever one it is, bullish, bearish, you have a much stronger, better potential of being right in that trade. So I'd first want to see it close, not even close, but get above, Aaron, and it may do it today, that 370.34. All right, so that's step one.
Okay.
Make sense?
Yep.
All right. Step two is, let me get Goldman Sachs option chain up then. So step two is to look at the options. So what kind of spread are we planning on this, Aaron? Are you looking at a credit spread? Are you looking at a diagonal spread? Which one do you think is the one that would work best for this, for what you're looking for?
For what I'm looking for, so if I'm trying to bet that they just, the stock isn't going to go down a certain amount, I would do a credit spread that pays me out.
Correct. The diagonal, you've got to spend some money, and unless you're anticipating a longer trade, meaning diagonal is a poor man's covered call. It's exactly what it's called. I've used that phrase for 20 plus years in the market. I didn't come up with it, but it's been out there for a long time. Instead of buying the stock, I buy a long-term option, at least 6 months of time or 4 months of time on Goldman Sachs, and then I sell a short-term option against it. So I agree that this would be something we'd want to do as a credit spread. So if we're looking at that level, that 350, actually it's 370.34. 370.34 is resistance right now. So I'd want to go ahead and look at the option chain, and you could set this up immediately as a credit spread, but I am not a fan of that. I'd rather look at the individual legs first. I'll trade it by turning this into a spread or a vertical setup, where I've got both strikes there. But I would rather look at each strike individually and make my decision from there. So I would want to be somewhere down below that 370 level. Right now, our numbers are going to be off a little bit because we have a price that is below that level now. The resistance is up here. We want to get above it first before we take the entry, right? So if we, let's do this. Let's use the example, Aaron, of that 358 instead, just to see what it looks like for now. And then we'll talk about what the actual strikes would be afterwards. Is that okay?
All right. Yep, let's do it.
Okay. So if we look at that 358 level, so I want to be somewhere down below that 358. And the trade we're going to do, folks, write this down if you don't know it. It's called a bull put spread. Bullish trade, using puts, spreading out our risk with options. Bullish trade, using puts, spreading out our risk with options. And what we're in essence going to do there is we're going to sell a naked put, and we're going to buy an insurance policy just down below that. So we're going to sell one strike lower than that 358, and we wind up at 357.5. We're looking at puts. Now, we don't have any premium today, and again, we're so far away with only 1 day left in the week. Let's say we're doing it for next week. So we're looking at that 357.5, Aaron. We're going to sell that. So we could sell the option, right? Right here, we could buy, and there's our mid price. So we want to sell. And if you look at these folks, if you don't, this is TradeStation that says sell by when you hover over it. If you're not sure, you forget, ask yourself one question you'll always remember. Which price do you want? Do you want to sell it for 310 or 330? Whichever one you want, you can't have. You can't have. It's always the one you don't want when you're trading options or stocks. What do you want to buy it for? The lower price. You can't. You're buying it for the higher. So we're going to sell this one for 310. I'm going to click on that. Okay. So once we sold the 307, 357 half, we've got to buy one strike below there. We don't want to buy further away from that. That would be a mistake. You only want one increment, one strike away. So we're going to go ahead and buy this one at 395. Okay. Or at least that's the way it's setting up. All right, so looking at 357.5, we're going to take in $3. Oh, what did I do? I did the wrong one, didn't I? So we're going to sell this, and my bad. We're going to buy the 355, one strike lower. So 266. I got to hold control. There we go. So we're going to change this from 5 contracts to just 1. We don't really need 5 contracts in there. If you go with the natural price on this, Aaron, they're going to pay you 42 cents. If you try to negotiate, which I always would, into the mid price, they're going to pay us 59 cents. is what we're looking for. That's assuming you're getting half of the bid-ask spread. So what did I just do here? I said the stock is trading at 368. If between now and next Friday, and remember we have a holiday in there, Monday the market is closed. Between now and next Friday, if the stock stays above 355, I get to keep that 50, we'll call it 50 cents, 42, 59. We'll say we got 50 cents. I get to keep that 50 cents of premium as long as the stock remains above that 355. So if the stock goes sideways and does nothing, I make money. If the stock goes up a little bit or a lot, I make money. If it goes down a little bit, 365, 359, 355. If it goes down a little bit, I make money. If it goes down a lot is where it can cost me money. Can cost me money.
Got it. Yeah, and I think, for a lot of people, I don't know, Rob, yesterday I was watching the option prices for contracts going into the CPI report. And like yesterday afternoon, looking at options that expired today, both puts and calls were like extremely expensive. And I kind of had a feeling that like maybe this is the report where we don't get a huge move on and all these expensive options, people are just kind of farming the premiums from them. And I was really thinking about, ways to position for that and how I could maybe implement a spread or something like that where, maybe a bunch of people were buying out of the money puts thinking the CPI report was going to be bad and SPY was going to drop a lot, or vice versa. People were buying out of the money SPY calls. And instead of selling those options outright, because if you're doing that, if you're just selling the options outright, you're setting yourself up with a lot of risk, right?
Correct.
So doing it through these spreads is a way to essentially take the side of like the market maker. So if I'm going to be on the side of the house, selling the options to these gamblers buying out of the money options and getting some of that premium back, but you don't have the risk of if you were selling those options outright.
Correct. And you use the perfect word for it, Aaron. Think of a casino. The house is the winner, right? They're the seller. If you're a seller, you have a better chance of being right. You don't need a lot of better chance of being right, but you do need to have a better opportunity. My risk in this trade, and that's because we had to go out for this example to next week, but my risk in this trade, Aaron, is there's a 27% chance this trade goes against me by next Friday on this trade. Do you know how I came up with that?
How?
The delta of the strike that I sold, that delta is a probability indicator. It tells you, and there's no guarantees, right? But it tells you this is the opportunity, the chance that this stock will have this strike rather, will have intrinsic or cash value come expiration date.
Yeah. I like that. And I don't know, some brokerages will tell you, what like your percentage of that trade hitting is or not. But like you said, there's another way to calculate it just by looking at the delta.
Correct. It gives you a quick down and dirty way to look at it. I mean, if we look back up at the current week instead, and if the stock is trading at 368 right now, and we went to, let's get a few more strikes in here. And we went to, from that 368, we went ahead and sold the 365s and we bought the 362 and a halves just to be closer to where we are for this week. So Aaron, I could pick up 51 cents right now. We'll call it 50 cents. Between the natural and the mid, you can get 50 cents. If I think the stock remains above 365 by tomorrow afternoon, I get to keep all that premium. And there is a 29% chance built into this that it goes against me. Now, if I look at that 50 cents, it's okay. It's a 20% rate of return if I'm right. If I am profitable on this trade, I made 20% on the cash outlay that I had to have on this position. But what if instead of the 65 and the 62 half, what do we have here? Where's the 65? What if we sold the 62 and a half and we bought the 65s? Now I'm only picking up 25 cents, but I only have an 18% chance of being wrong on that trade. So when you buy an option, if I bought this option, I only have an 18% chance of being right in this trade. That's why we buy options that have a 65 to 85 delta. It puts you on that bell curve in that sweet spot, 85 being the higher range of it. Anything down below that 65, you're getting a little bit too much risk as a buyer, the way that I trade them. So I look at this as always as a probability indicator. It's not a guarantee, but it gives you a very quick, down and dirty way of analyzing what the market maker sees in the position without them having to run all kinds of models to see what's the probability of this position. They use the delta as part of it.
I love that. That's some good insight there. And I'm going back to the casino analogy real quick. So let's say, like, you know, if you could go to the casino and get exposure, say, okay, instead of playing blackjack, you're going to, you know, have $100 on the side of the blackjack dealer and get paid out, you know, $120 whenever. Well, I would assume, but like, why don't more people do this, essentially, is like what I'm getting at. Because I think if you told people, hey, you can get on the side of the house, you know, I understand the downside, I guess, is like, you know, you're setting yourself up to not have as crazy of returns as if you're on the side of the people buying the options. But like, why do you think more people don't do this, implement this strategy of taking the side of the house, taking the side of the market that's proven to win time and time again?
A couple of different reasons. I think a big part of it is education. I think some of it is fear. And I think that some of it is the broker, you know, many of the brokers out there, I think they take the wrong position on options trades. So I'll give you an example. I purposely removed the protection leg on this, Aaron. So I now turn this trade into a naked put, right? I would go ahead and sell the 362.5 put, which means as long as the stock remains above 362.5 by tomorrow, 4 p.m. Eastern, it expires. I would keep that 66 cents or 69 cents, depending on the negotiation, but I'd keep that 70-ish cents for myself. If it drops down below there and I do nothing and it closes 1 penny below that 362.5, they're going to make me buy that stock, and I need to have the cash in order to do so. So brokers look at the trade setup and say, well, wait a second now. This is a really risky trade. You can't do this. Well, but wait, I've got $100,000 in my account. If I did one contract of this, I need to have $36,000 to do this. Who cares? I've got that in my account. No, the risk is too high. Can I buy 100 shares of stock? Oh, sure, you could buy the stock. I think part of it is just the brokers of what they allow, right? And the other side of it is the education. What I mean by that is when I would teach this to a live audience, still to this day, when I teach naked puts or spreads, you could see remember Charlie Brown Christmas movies and Thanksgiving and all of that, Aaron?
Yeah.
Remember Charlie Brown's teacher?
Yeah, where you just wah.
Charlie Brown's teacher shows up, and I'm teaching this, and people are going, but they really aren't grasping what I'm getting into, what I'm saying.
Well, that's the beauty of doing it on here, is for you folks out there, if you know, think you're having trouble, you know, figuring this out, we're on YouTube. Go back, watch it again, watch it 5 times, watch it as many times as you want. Come to me, come to us with questions. Next time we have Rob on, we can ask him the questions.
Yeah, it's a phenomenal tool, isn't it? When you think about it, compared to what we had to do when I first started in 1997, you didn't have any of this. The internet was barely a suggestion at that point.
Yeah, it's crazy how quickly, you know, and I mean, now you've got the Chat GPT and the AI. I mean, I have no clue what it's going to look like in
$20
5,
billion
10.
valuation on that thing.
What was it? 30 billion, you said?
I heard 20. I heard somebody say 20 billion today.
Yeah. I mean, I believe it. The
That's right. I agree.
The Open AI guy is actually from my neighborhood in St. Louis.
Nice.
The guy who runs it. Yeah.
Very nice.
Yeah. Let's see if we've got any questions in the chat. Let's see.
What stocks do you want to look at?
I don't know, you guys. What stocks we want to look at? Let's see. EKS said something about Goldman cutting jobs, and it's been surprising to me. I guess surprising, I guess to say, but like you've seen certain big companies, right? Amazon, Goldman, whatever, start laying off people, but the unemployment number has remained strong. It's not really that worrisome to me. Like I don't see that and get super scared for the economy. And honestly, seeing the stock prices actually trade higher off these news of layoffs, maybe the market likes the fact that they're kind of cutting some costs and saying, okay, they probably could have done without a few thousand of these employees anyway. I don't know. How do you interpret that? Interpret that, Rob?
I agree. I think that this is the start of what's to come. Remember, to get the Fed to get inflation under control, what do they want to see? Unemployment go up, right? Less people having jobs. I think
Yeah.
we've got a very high real estate market from 6 months ago. You know, my wife and I are looking in Florida right now. We're not ready to buy today, only because the market's not there, in my opinion. But we're looking at Florida for a snowbird place, right? Well, when you look at houses, she sent me one today. I didn't get a chance to look at it, but they dropped it from a month ago, $75,000 on a $500,000 house, right? Now, granted, they bought it for $280,000 3 years ago or something like that. So, but you're seeing, go back and look, and I see stuff from June that they listed where they listed a house at $350,000 and now it's up at $279,000. You know, it's just they've cut it 4 or 5 times and can't sell the property, right? So I think the real estate market's very high, meaning you're going to have people with good interest rates, absolutely, for their mortgages, but they're going to get to a point that if unemployment kicks in, they can't afford to keep that house. Certainly in Florida, the areas we're looking at, it's a lot of second homes there. So,
Yeah.
you know, it becomes I don't have a choice, I have to sell, right? A non-liquid asset in a bad economic condition or economic market. So I think we still have the concerns of where the economy goes. The Goldman, I did see 10% was the number. CRM was another 10% that they're laying off, right? Amazon said they hired what? From COVID, 280,000 people from COVID. Right? I mean,
Something like that. I mean, yeah, they've had some crazy just having to keep up with demand. And I think with Amazon too, like I saw those layoffs, but I think every year they kind of cyclically lay off some temporary employees, like after the holidays and whatnot.
Sure. And I'm sure that's part of it. So, but I look at the unemployment factor as, if we need the unemployment to increase, that means we're going to have more people needing assistance, right? And less people getting a regular paycheck without the government assistance any longer of, here's a check. I mean,
yeah.
If you remember, my daughter, she worked at Planet Fitness while she was going to college. She worked at Planet Fitness, and there was no more gyms, right? They had no, so she lost her job. So unemployment was, oh, you say you get unemployment? No problem. File for it and you got it. And then we go to file her taxes and we get this threatening letter from the government of, you better file this the right way and send this paperwork back to us, and you've got to prove this and that. And if you don't, you're going to have to pay this and penalties and taxes. I'm like, whoa, where'd this come from? You know, that free money was gone, right? And you don't have that any longer. And we've got to worry about that with the economy if the layoffs do continue. So I think it's kind of I need to take notice of unemployment if it does start ticking up to some of these big companies, because it can trickle down into some of the others.
Yeah, I guess just like kind of to play like devil's advocate to that, I think a lot of people thought when we saw, you know, a lot of big tech companies start their layoffs, you know, if you go back to say like, you know, when Netflix started laying people off and Tesla, this was all like months and months and months ago, right? When the Fed started raising interest rates, a lot of people were like, this is the tip of the iceberg, you know, just wait. And we haven't really seen that unemployment number come up. So I don't know necessarily like if Netflix, Tesla, Amazon, Carvana, Coinbase laying people off, and now Goldman and some of the big banks is indicative that that's going to reverberate throughout the whole economy, right? I've said on the show, and I'll continue saying it, when I start seeing like Walmart laying off, not, you know, executives or office job people, but like everyday employees at stores, or FedEx start laying off drivers, stuff like that, that's when I'll start getting concerned, is when I see unemployment rising among people that are active in like the everyday, day-to-day goods and services economy. The fact that Goldman wants to lay off 10% of their bankers that I don't even know what they were doing to begin with, you know. So to me, I don't know if 100% that means just because Goldman's laying off people, that means FedEx and Walmart are going to have to too.
Agreed. But FedEx did a restructuring, right? When their earnings came out, they said they had to restructure because they didn't make what they thought they were going to.
Right. So that is concerning. That's more concerning to me than Goldman laying people off. So I think just watching all these things, like you said, the Fed wants to see unemployment come up. So we have no reason to believe they won't keep raising rates until that happens, which, like we've seen today with a lower number of jobless claims that were expected, still has not yet happened. So definitely that's something to watch out for. Rob, real quick before I let you go.
Sure.
I see someone was asking about Netflix, basically just saying Netflix seems really overbought up here.
And is it overbought as a long-term buy? Maybe. But to me, is it overbought? Maybe it's overbought today, right? It's too high today, but If it closes where it is tomorrow, listen, Netflix, Tesla, and Roku were probably my top three in the last half of 2022 that I traded. Was those three stocks: Netflix, Tesla, and Roku. And when we look at Netflix right now, what am I looking for? Get me up a little bit higher tomorrow, maybe to 333 or so. Close there tonight too. That would be fine. 334. Give me a pullback towards the 331 in the bounce, and I will be all over it, over and over and over and over again. But to try to take this breakout, this is exactly what I'm talking about now. And you see what happened here? We broke out of that resistance line with the wick. There were buyers there, and it failed. Right? We popped up again today. I can't buy there. I've got to be very cautious. And hold on. They've got earnings coming up, though. The 19th. Does that sound right? On Netflix. So we got to be careful with their earnings.
Yep. And I mean, with Netflix, you know, talking about it looks overbought here, or, you know, whatever. It's all relative, right? And it all depends on your time frame. If you were looking to buy and hold Netflix for 10 years, it might not matter as much to you whether you get it at 330 or, you know, 300 or 280. If you're looking to swing trade it, then yeah, you want to make sure you're getting in at the right price point. And you can say, oh my God, this thing's $330. It was $180 a couple months ago. It's so expensive and overbought. Or you could say, oh my God, this thing's only at $330. It was $800 a few months ago. It's cheap, you know, so it's all relative how you want to look at it.
And that's why I backed the chart up. We were at about $700 here, right? So yes, I agree. It is all a perspective on where you are at in that position. I'm looking at Amazon, Netflix as just based on this pattern. If we can get that break to the upside and a retest and a bounce, I will be all over this tomorrow as a bullish entry. But if we close about where we are tomorrow, and instead of that move to the upside, if we get this move down, if we close where we are, we fail a little bit tomorrow, come back, retest, and drop, that is my bearish entry long put on a Friday. The cheapest day you could buy an option is on a Friday, and I'll be looking for that next support level as my target. And on top of that, we have a confluence with our 8 moving average right there. Now, we may not make it to that level, but that's the ultimate target. We'll use the intraday charts to manage the trade once we're in.
Got it. Yeah, I mean, I personally like Netflix. I do like it long term. I agree with whoever was saying up here that I'd be cautious about getting in up here, just that you've seen such a rally the past few months. But like we've said before, a lot of times the trend is your friend. You never know. But I'd wait till after earnings at this point.
Unless I'm day trading it. But if you're looking to
unless you're day trading, obviously.
If I'm looking to buy it and hold, I would not do it prior to earnings. Unless A, you have a very long-term bullish perspective of it, and B, I would then I'd have to go out and buy a protective put. So if it did come crashing down, not down a little bit, not it fell a couple of points, 5 or 10, that's not what I'm looking for. If it drops 30 or 40 points, I want to have some protection in there. And I would buy that protective put, which is just an insurance policy. Yes, you can buy insurance on your stocks. It's an insurance policy if it has a major move. This is car insurance. We don't buy it in case a kid snaps the antenna off the car, if they even have antennas any longer. We buy it in case someone ran a red light and has no insurance and totaled my car. Right? That's why you have the insurance for major concerns, major issues.
Yep. And they do still have antennas. They're just a little bit, they might look a little bit different than they did back in the day. I missed the big antenna. You know, remember when people used to put like tennis balls and stuff on their antennas?
Oh, yeah. I went to Arizona and it was my cousin's house. It was snowing in the mountains. We drove up there, came back. The big joy for the kids were making big snowballs and they put them on the car antenna and they watched them melt as we got back to 120 degrees.
There you go. That's some pretty good car entertainment for the road trip for the kiddos. All right, Rob. Well, it is 1 p.m. It's time for us to jet. Thanks again for hopping on the show today. I'm going to go ahead and drop that link in the chat. tradinglikeaboss.com if you want some more from Rob and from Wealth Builders HQ. All the great information on that site. I'll pop that screen up as well. We've got the link in the chat. Rob, enjoy the rest of your Thursday. Have a great weekend.
Great. You as well, guys. Go to this Becoming a Pattern Whisperer. It is a free class we've got coming up this upcoming week on how to read these exact types of patterns. So go ahead.
That's my boy Benson. That's my boy Benson. I haven't had him on the show in a while.
Yeah. Tony's teaching. He's the pattern whisperer. He's been doing it for over 20 years. He looks at a pattern and I'm like, I don't see it. And 3 days later, it does exactly what he said. So He is an amazing trader, guys. Check out his free training that he's doing for it.
Beautiful.
Cool.
All right. Well, we'll stay in contact. We'll see you next week. And take care, Rob.
All right, guys. Take care.
All right, y'all. That was Mr. Rob Roy from Wealth Builders HQ. It is 1 p.m. You know what time it is. You know what that means. It's time to head over to Money Mitch over on Stock Market Movers. Mitch will be talking to Bill Adams, chief economist for Comerica Bank, showing some Detroit love on the stream. We're getting Comerica. We got Mitch. We got me, downtown Detroit. Let's go. All right, smash the like if you have not already. Stay tuned. This stream will redirect you automatically over to Money Mitch. You do not need to go anywhere. We'll be back tomorrow, 11:30 a.m. normal time. Next week, shorter week, we'll be back Tuesday. No show Mondays for Martin Luther King Day. So peace and love, y'all. Again, smash the like if you have not already. Please subscribe to the channel. Give me a follow on Twitter, wherever that thing went. Stay tuned for Money Mitch.
This is